Good morning. It is time to rise and save. Today we're talking about our home series because some big news just dropped. Interest rates dropped. So we have Nick Dotson this morning here with STCU and the Home Loan Service Manager. That's your title, right?
Yeah, that's what it says on my name tag.
Says.
Yeah.
Thanks. It's a good reference. Nick, thanks for being here. I do want to jump right in because that is big news. People have been watching interest rates for a while now. Tell us what this means for the market. I mean, low sixes, high fives. What does that actually translate to?
Yeah, it means that there's going to be some people that have gotten into mortgages in the last few years that have higher interest rates, and maybe it's time to look at refinancing that loan into a lower interest rate and getting a lower payment.
Okay, so for someone who's not in the game, if you will, and they want to maybe think about buying a home, is now a good time to maybe start thinking about it?
Yeah, it's actually an interesting time in our market here in Spokane, because prices have actually softened a little bit, as much as around 3% or so. And also, there's more inventory in our market. I think inventory is up something like 15 to 20%. So there's more houses on the market right now. And affordability is actually a little bit better because rates have dropped a little bit and prices have softened. So I think right now is actually a pretty decent time to take a look if you're in the market.
Yeah, and if someone's thinking about applying for a loan, there's a lot that goes into the rate that they get.
Yeah.
Can you talk to folks about what are some of those factors that go into the rate? Because they see on the news maybe high fives, low sixes, but it can also vary depending on their situation.
Yeah, the factors that determine interest rate typically are your credit score. So that's your history of repaying loans in the past. You get scored on that, and that's on your credit report. And you can check your credit score for free most of the time through your online banking service, or there's a free credit report website called freecreditreport.com. So you can check those things and see where you're at. Another factor is how much money you put down when you purchase a home. The more money down, the lower risk there is to the financial institution, and you're able to get a better rate.
And then sometimes people, at a high level, people hear the term fixed versus adjusted. What are the differences between the two, and when is it beneficial to go for either of those options? Yeah,
good question. So fixed rates stay the same for the entire term of the loan, whether that be 15, 20, or 30 years. An adjustable rate mortgage will change after a certain period of time, like say 5 or 7 years. It'll stay fixed for that first 5 or 7 years, and then after that, it'll start adjusting year over year.
And is there
based
a cap?
On the market? Yeah, and there's caps, so it can only adjust a certain amount each time it adjusts. But typically, people that are looking at those adjustable rate mortgages are thinking more short term. Like maybe I'm not going to live in this house for the next 10, 15 years. I'm just going to live here for the next 3 or 4 years. So I'm going to go after an adjustable rate because it's typically lower than the fixed rate mortgages.
That makes sense. All right, real quick, Nick, let people know how they can get a hold of you if they have more questions.
Well, you can look us up online at stcu.org. You can also call our home loan team at any time at 509-344-2966, and you'll get somebody on the phone right now. Like if you were to pick up your phone and dial that number, you'd get somebody that picks up right now.
Okay. All right, Nick, thanks so much. And looking ahead, you teased it a little bit. You talked about refinancing. Next time we hear from Nick, we'll be talking about just that.